If you're a first-time homebuyer in the state of California, you are well aware that between high home prices, high interest rates, affordability is at a 40-year low. On top of that, just saving for a down payment and closing costs can be difficult. What if I told you the state of California has a program and wants to help? Well, the good news is they absolutely do. For 2024, they are back with the California Dream for All Homebuyer Assistance Program, which is a shared appreciation loan. Stick around, because I'm going to walk you through exactly what the California Dream for All Shared Appreciation Loan Program is, how it can help you as a first-time homebuyer, more importantly, how to determine if you are eligible. We've also created a free tool that you can use to go through examples of different purchase prices to determine whether you're eligible and what the repayment terms would look like at the end of the loan. We're going to walk you through everything you need to know to determine if the Dream for All program is right for you. And once you make that decision, I can show you exactly how to get pre-approved and how to apply for the Dream for All lottery to see if you can get selected to be one of the lucky few who will be able to use this program to buy their first home. Let's go through exactly what the California Dream for All Shared Appreciation Loan is and how it works. As we mentioned, it is a down payment assistance of up to 20% or $150,000. So let's look at kind of how that works out. If you bought a home for $500,000, 20% is $100,000. So you would get the full 20% at $100,000. Now, if we bump up and say you're looking at an $800,000 home, well, at $800,000, 20% is $160,000. You would only get the $150,000 assistance because that is the max for the program. So one of the improvements over last year, borrowers were able to get much bigger assistance, and disproportionately that benefited buyers of more expensive homes. The state is trying to help more people and get in at entry-level price points, even though in the state of California, many entry-level homes are priced at the $1 million range. So with that, you will have no monthly payments on the down payment assistance that they are giving you. You will repay that at the end of the loan in the form of shared appreciation. So let's go through a simple example. Back again at $500,000. Currently, the Cal HFA rates are around 7%. We'll see where they are when the program rolls out much later in the spring and early summer. But with a $500,000 purchase, if you were to do your own 5% down and you got a 7% interest rate, you would have a principal and interest payment of about $3,142, and you'd also have mortgage insurance of about $158. So $3,300 more or less for your principal and interest plus your mortgage insurance. So that doesn't include your taxes and insurance, and that won't change whether you use Dream for All or not. Now, let's take a look at how that same $500,000 purchase would look using Dream for All. Now you have a 20% down payment. So your payment on the mortgage goes down to $2,645 a month, and there's no mortgage insurance because at $500,000, your 20% assistance actually gives you a full 20% down payment. So the difference there on that $500,000 purchase is $654 a month. So not only did you not have to come up with your own down payment, you have a much smaller loan, and you've eliminated mortgage insurance, so you have a significantly lower payment. You're probably seeing pretty simply how this can benefit you as a first-time buyer. But at this point, you're also probably saying, cool, there's no free rides. So how do I pay this back if I'm not making monthly payments? You repay the loan. There are certain triggering events. The obvious and simple one would be if you were to sell the property, if you were to transfer title to the property, if you were to move out of the property. At the end of the 30 years, when the first mortgage is paid off, that is a triggering event and you would need to pay it. If you decided to do a refinance where you took cash out, that would be a triggering event. You are allowed to refinance this loan one time solely to lower the interest rate on the first mortgage. But if you wanted to take advantage of, again, a further drop in rates later on in the future, that second rate and term refinance would trigger repayment. So cool. Repayment. What does that look like? Let's go back to our $500,000 example. You borrowed $100,000. So let's say you lived in the home for 10 years, and over those 10 years, it went up 3% a year. So when you sell the home for just a hair under $675,000. That means your home went up $175,000. There was $175,000 of appreciation in the property that needs to be shared with the state of California. They put 20% down, so they get 20% of that appreciation. In this example, that would be $35,000. So you owe the state the $100,000 that they loaned you for that 10 years, plus $35,000, which is 20% 80% of the shared appreciation over the 10 years that you owned the home in this example. So what does that look like? After selling the home for $675,000, you pay back the $100,000 in principal, you pay back the $35,000 in shared appreciation, and you pay back about $343,000 remaining on the loan because you'll have paid it down over the life of that loan. So at the end of the day, you walk away with $200,000 from that sale that you would not have otherwise had because you got to get into that home with no down payment out of your own pocket. So that is exactly how the repayment works. You get to own the home, you get a much lower payment, and there's no bill to be paid until the time comes when you sell the home, which if it's far enough in the future, you're likely to have a nice profit that you are then sharing that appreciation with the state of California. At this point, you might be saying, that sounds awesome. I want that. Well, it is important to remember that there are eligibility requirements. Not everyone is eligible for this program, and there's been some pretty significant changes since last year. The reason for that is the money went really fast. It was a chaotic sort of rollout last year, and the state stepped back and said, we like the program, we like the idea of helping people get in and buy their first homes, but we did not like the way that worked out. All right, let's take a look at those requirements and help you determine whether you are eligible for the Dream for All program. First one's fairly obvious. You must be a California resident. It's a California funded program. They don't want people moving to the state of California. They want to help those that are already here. You must be a first-time home buyer. They don't want to help people that already own homes to buy bigger homes, better homes, relocate. It's for those who are having a hard time getting into the market, buy their first home. There are income limits. We don't want to help people that make $1 million a year buy homes with taxpayer dollars. So the downside on this is they are lower than last year. Last year they followed the standard Cal HFA guidelines. This year we have Dream for All specific. So I will put a link down below, and in the tool that we're going to walk through, it shows you, if you select your county, it will show you exactly what your income limits are. But as an example, Los Angeles County had the largest number of recipients in the state last year, and the standard Cal HFA limit is $194,000 income. Well, for Dream for All this year, it's at $155,000. So it's right about 80% of the standard Cal HFA limits. So be very careful. If you've checked and you are eligible for Cal HFA, that doesn't mean that you meet the income requirements for Dream for All. You want to check out our tool, check out the PDFs that they post at the Cal HFA website. Now, we have some interesting and new requirements for 2024. The big one that you have probably already heard is that you must be a first-generation home buyer. So what does that mean? It means simply that your parents cannot own a home, or if your parents are deceased at the time of their death, they could not have been homeowners. And you may be asking yourself, is there a database that collects all this information? How would the state know? They are going to have you attest to this under penalty of perjury. And they also say they are hiring people to do background checks to vet this and check it out. So I don't know how they would find it. I don't know that there is a database. In addition to being the right thing to do in terms of telling the truth, you are going to be attesting to that under penalty of perjury. And it is always possible that they could find out whether your parents are first-time homebuyers. Now let's talk about some basic loan eligibility requirements. Debt to income ratios. It's a maximum 45% for credit scores under 700, and it's a max 50% for credit scores over 700. So that's fairly well aligned with standard Fannie Mae, Freddie Mac guidelines. There are no non-occupant co-borrowers. Many of you may be aware that with an FHA loan, with a Fannie Mae loan, you can have a friend or relative co-sign with you, but not live in the property. That is not an option with this loan program. We have some property requirements. It's single family, 1-unit properties only. That doesn't mean only single family homes. Condos and townhomes are allowed if they meet the Fannie Mae guidelines. Manufactured homes are allowed if they meet the Fannie Mae guidelines. It's important to know that you will be required to get a 1-year home warranty, which is included in most transactions. Most people negotiate that with the seller, and you can pay for it yourself if the seller doesn't want to cover it. Also important to remember, homebuyer education, 2 forms of homebuyer education. There's a general homebuyer education course that you have to go through, and then there's a second piece to fully explain what the shared appreciation program is for you. At this point, you may be saying, great, I think the program sounds awesome. I think I'm eligible. I want to apply. How do I get in? One of those big changes from last year is that they've created a lottery system. Last year, what happened is the first 1,800 people or so that qualified for the program and got a property under contract and put in a reservation request got those funds. So this year, they wanted a more controlled process. They wanted to make sure that in addition to adding those requirements that we're helping those most in need of help, that we have sort of a more controlled process and some certainty where you can know that you have a reservation and you have 90 days to go out and get a property versus maybe buying a property that isn't perfect for you just because you want to make sure that you get to use the program. So your first step is getting pre-approved with a CalHFA approved lender or broker. I'm a broker. We are not a direct lender, but we have several of our sources that we fund CalHFA loans through, and we can do that pre-approval for you. So we pre-approve you. We give you a certification that you meet the CalHFA guidelines, and at that point, you go to CalHFA and apply for the program. You go through that process. You provide all your documentation, including our pre-approval. At that point, CalHFA is going to go through and vet all of the applications, and those that they deem to be eligible will be entered into a lottery. So timelines on this are important. They have not started accepting applications. We're expecting sometime first half of April, they will accept those applications, and that window will be open for about 30 days. This will take time. There's going to be a number of applications. They have hired a large staff to vet these applications, but I would expect it taking a little longer than they think. So somewhere in the month of May, early June, you will find out, were you eligible? And was your application selected in the lottery? And if so, you will be given a voucher and you will have 90 days to go out and find a property. So that is very good news. So if everything sounds good, let's jump over here and take a look at the simple tool we've put together on our website where you can determine if you're eligible, what the payments would look like for you, and what repayment would look like based on different assumptions for appreciation and how long you own the home. So let's take a look at that tool that we've created for you to look at not only your eligibility, but what repayment terms would look like under different scenarios of appreciation and length of ownership. You can find the link to this calculator down below in the description. So it's going to ask you, first of all, if you're buying by yourself or if you have a co-borrower. All this really says is, or dictates, is how the questions are going to be asked. So it's going to ask you, do you have a 680 credit score? Are you a California resident? Are you a first-generation home buyer? Are you a first-time home buyer? And if you need help with any of these, you can see all of the definitions right there just by clicking that box. But let's go back over and say you will have a co-borrower. It just changes how it asks you. Does every borrower have a 680? Is at least one borrower a California resident? Is at least one borrower a first-generation home buyer? And is at least one borrower a first-time home buyer? So we answered yes on all of that. Now, keeping with our example, let's go back to Los Angeles, and let's say that your family has $132,000 of total income. So the good news is it shows we are under the income limit. So good news, you qualify for the Dream for All program. Checks all green there, shows you the maximum income limit, the maximum loan amount, and it shows that we're over 80% of the area median income. So if you were below that and you still qualified for the mortgage, there are some benefits in terms of a reduced shared appreciation rate and a reduced mortgage interest rate. But for our scenario here, let's go back. We're going to stick with $500,000, even though that is low for Los Angeles County, just for consistency's sake. So one thing you're going to want to see here, let's set this to 0. So your 20% assistance would do a 20% down payment of a $400,000 loan amount, $2,661 in terms of the monthly payment. So the program will give you $100,000 for your down payment and or closing costs, which means that we can use a portion of that for your closing costs, not just for your down payment. So let's say you did not have money or did not want to use money. You didn't want to borrow from a 401k or use up all your savings to cover your closing costs. Let's say we wanted $15,000 for closing costs. We can do that. Now we have 17% assistance. We have 3% for closing costs. Still equates to the total of $100,000. You will have some small mortgage insurance. So CalHFA qualifies for a lower mortgage insurance rate, and with 15% down and a 680 and above credit score, it's going to be fairly minimal, but it would add a little to the monthly payment, but requires you to come up with less out of pocket. Now let's look down. This is where I find this to be interesting. So we have this defaulted in here to 7 years and a 4% appreciation rate. Over the long haul, California has appreciated well over 5%. But let's say we want to look just like we said in our example, 10 years forward in the future, and 3% appreciation rate. Gets us to about 672 on the value. And then this is what that would look like. So the future home price, 672 minus the purchase price, 500. So we've got 172,000 of appreciation. Cal HFA's 20% share is a little over 34,000. This is your appreciation. So good news there in that this allows you to walk through. It gives you a bunch more details here, other things that you can factor in. What's it going to cost me to sell? What's that price? What would I net and walk away with at closing? Also, just a nice summary of additional guidelines. We have all of the income limits by county. So everything there for you. I think it's a really, really cool tool to basically answer almost all of the questions that you might have about the program. So hopefully you have a pretty good overview of the program. In my opinion, this is one of the best assistance programs there is. In most situations, I do not believe the benefits outweigh the costs. This is not one of those cases. Dream for All, if you are eligible and if you are selected in the lottery, is probably the best assistance program you would ever have to be able to purchase a home. Use our tool, see if you're qualified, see if you're eligible, see what the repayment terms would look like. If you have questions, post them in the comments below or reach out. In the description, you'll see all of my contact info. Would love to help you with this. If you're ready to get pre-approved, see if you fully qualify and would like to apply, we'd love to help you with that. Thanks for watching. Have a great day.